Oil just hit the 94th percentile. And oil at this percentile has preceded demand destruction in 4 of 5 cycles. Something is breaking beneath the surface, and the data confirms it. Right now, VIX is at 24.2, the 90th percentile for the past year. Historically, volatility at this level has preceded sharp equity sell-offs within weeks, says the data needs to confirm. The commodity analyst says, we are in a commodity supercycle driven by underinvestment and deglobalization. In the next few minutes, I will show you who the data says is right and what it means for your money this month. The scoreboard just changed. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. The commodity analyst is right, and the data keeps proving it. Oil at $94.6, 98-day streak, score 1 for Gammon. Credit will blow out. Investment grade spread agrees at 85 basis points. 22-day streak, McElroy is waiting on confirmation. The narrative holds, but the data has not validated it yet. 97-day streak. Hartman is waiting on confirmation. The narrative holds, but the data has not validated it yet. 91-day streak, too early to call the dollar analyst right or wrong. The thesis is building but not confirmed. 7 days running, the volatility expert just moved from right to early. The volatility expert is waiting on confirmation. The narrative holds, but VIX has not validated it yet. Snyder just moved from right to wrong. Snyder is wrong. For now, for now, for now, for now, for now. Yield curve at 0.52% is moving against the thesis. Score today, 2 right, 4 early, 1 wrong. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. Today's big question, are commodities in a supercycle, or is this the top? On one side says, the data needs to confirm. That is the setup. Everyone hears it on the podcast. It sounds convincing. On the other side, the commodity analyst says, we are in a commodity supercycle driven by underinvestment and deglobalization. Two smart people, opposite conclusions. So who is right? Here's what makes this interesting. Oil is falling while gold is rising. Those two signals should not be going in opposite directions. When they diverge like this, one of them is lying, and the resolution is usually fast. Oil at $94.6, 94th percentile, down 16.2% today. Gold at $4,822, 84th percentile, up 3.5% today. Copper at $5.74, 80th percentile, up 3.6% today. Bottom line, right now the commodity analyst has the better case. Oil at $94.6, 94th percentile, says the data is moving their direction. If oil drops below $80, the supercycle calls in trouble. Right now it is at $94.6. If copper breaks to new highs while oil falls, it is demand rotation, not a supercycle. Oil at $94.6 is in the 94th percentile reversal territory. If it drops below the 75th, the thesis weakens fast. Gold at $4,822 will track it daily on the scoreboard. None of the 7 are talking about this next signal, and they should be. High yield spread just dropped 2.6% to 305 basis points. A move this size demands attention. Historically, high yield stress at this level signals institutional risk aversion building. None of the 7 are talking about this. Keep it on your radar. Phase 1 is the good times, but good times did not last forever. Here is how close we are to the edge. We are 65 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment grade spread crossing 150 basis points, currently at 85 basis points. Pace is flat or improving. No urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has yield curve, copper-gold ratio flashing red. Gammon says the Fed is breaking things and credit spreads will blow out. The data agrees with that assessment. Phase 1 holds with 65 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the ZIP level data is screaming about today. Orange, CA, people moving in can't afford to live here. 110,160 households moved into Orange, CA. Their average income, about $105,000. Median home, about $4,385,000. Unsustainable migration pattern. Demand without purchasing power. Demand without purchasing power. Santa Clara, CA. People moving in can't afford to live here. 82,469 households moved into Santa Clara, CA. Their average income, about $146,000. Median home, about $4,336,000. Unsustainable migration pattern. Demand without purchasing power. Orange, CA. Payment burden is past the breaking point. Newport Beach, CA. Median home about $2,630,000 on a about $138,000 household income. Price to income ratio, 19. When the math stops working, sellers find out before buyers do. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, are commodities in a supercycle, or is this the top? Let me show you what happened the last time we were here. Oil at $94.6 is in the 94th percentile. That means it is higher than 94 out of 100 days in the past year. In 2022, oil spiked above 120, then demand destruction pulled it back 40% in months. In 2020, oil went negative for the first time in history as demand collapsed. In 2018, oil dropped 40% in Q4 as growth fears overtook supply concerns. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, gold at $4,822 is in the 84th percentile. The last time both oil and gold were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. If history rhymes, the commodity analyst is on the right side of this trade. The data is not ambiguous. Here is what the data says to do right now. Stay alert on gold. It is surging 3.5% today. Fast moves demand attention. Avoid Denver at 36% payment burden. That is stretched territory. Watch high yield spread. It dropped 2.6% and nobody is talking about it. Every signal is live at analyze.builderslens.com. The talking heads give you opinions. We give you the numbers. Subscribe and I will see you tomorrow morning with a fresh scoreboard.